All right, let's talk about some massive, and I mean massive changes coming to how cash is handled in India. These aren't just small tweaks. They're a huge push to track money and move everything digital. So if you ever use cash, whether you're selling a car, getting a gift, or running a business, you absolutely need to hear this. Let's dive right in. So let me paint you a picture. Imagine you just sold your old bike or maybe some family jewelry. You get 3 lakh rupees, all in cash. Feels good, right? Well, under these new laws, that single move could cost you the entire amount in penalties. Yep, you heard that right, a 100% penalty. This is a game changer, and it shows just how seriously the government is now tracking cash. So, where is all this coming from? It's all part of the new Income Tax Act of 2025, and it all officially starts on April 1st, 2026. Knowing these rules now is going to save you from some honestly shocking penalties later on. So, we're going to walk you through everything, step by step. Here's our game plan for today. First, we'll get into the new reality of what these cash rules actually feel like. Then, we'll tackle the big one, the limits on receiving cash. After that, we'll look at spending and depositing it, and even what happens when you try to withdraw your own money. And don't worry, we'll wrap it all up with a super simple checklist. Okay, first up, the new reality. The government's basically laid out 4 different levels of consequences for handling cash. The easiest way to think about it is like a color-coded warning system. And this chart here, it's the perfect snapshot. Think of that red slice as a giant stop sign. That's the 100% penalty we keep talking about. Then there's orange, which stands for a painful 84% tax on any cash you can't explain. Blue's for TDS, which is when tax gets deducted right at the source. And finally, gray is for simple reporting, where big transactions just get flagged for the tax department. We're going to break down what triggers each one. All right, let's get into the part that's going to affect pretty much everyone, receiving cash. Doesn't matter if it's from a sale, a loan, or even a gift, the limits are now incredibly strict. This number. Burn this number into your brain. 2 lakh rupees. If you go over this limit in a single cash transaction, or even for a single event, boom, that's what triggers the 100% penalty. The takeaway here is really simple. Whatever you do, stay under this number when you're the one receiving the cash. Now, what's wild is just how broad this rule is. It's not just for selling some big ticket item. We're talking about everything. Taking an advance on a property deal, taking back a personal loan you gave a friend, even getting a security deposit for your rental flat. If it's 2 lakh rupees or more in cash, the penalty is 100% of that cash. Seriously, there are no exceptions here. And of course, cash gifts have their own little maze of rules. It's a 3-level system. So from non-relatives, anything up to 50,000 rupees is totally fine, no tax. But the second you cross that, even by 1 rupee, all the way up to 2 lakh, the whole amount gets taxed based on your income bracket. And you already know what happens if you cross that 2 lakh line. You guessed it, that 100% penalty hammer comes down. Okay, so you've got some cash and you followed the rules so far. Great. But now what? What happens when you try to spend it or, just put it in your bank account? Well, that brings us to our next section. And just so we're crystal clear, we aren't just making this stuff up. All this information, like the details you see here, is pulled directly from the official summary of the new Income Tax Act. We're just here to break it down and make it easy to understand. Remember that orange slice on our penalty chart? This is where it comes into play. If you deposit a bunch of cash in your account or it's found some other way and you can't prove where it came from, the government can tax it at a mind-boggling 84%. So what does unexplained actually mean? Well, it's pretty much what it sounds like. It's any cash that you can't connect to a legitimate source with paperwork to back it up. You have to be able to prove how you got it, whether it's from your salary, your business, a legal sale, whatever. If you can't prove it, it's unexplained. Now, the rules for spending are also super tight. For business owners, listen up. Any cash payment over just 10,000 rupees to one person in one day gets disallowed. That basically means you can't claim it as a business expense, which jacks up your taxable profit. And it's the same for buying assets. For the rest of us, it's about our bank accounts. If your total cash deposits and withdrawals for the whole year go over 10 lakh rupees, your account automatically gets flagged and reported to the tax authorities. We've covered receiving it, spending it, and depositing it, so there's just one piece left in this puzzle. What are the rules for taking cash out of your own bank account? And this is where that little acronym TDS comes into play. It stands for Tax Deducted at Source.
And it's as simple as it sounds. When you go to withdraw a large amount of cash, the bank is now forced to chop off a percentage for tax right there on the spot and send it straight to the government. And this is where things get really interesting. Whether you file your taxes or not makes a world of difference. If you're a regular tax filer, this TDS only kicks in after you've pulled out over 1 crore rupees in a year, and it's at 2%. But if you haven't been filing your returns, the rules get way, way tougher. The starting line drops to just 20 lakh rupees, and the tax rates are much higher. It's a very clear message the government wants you to be tax compliant. Whew, we've gone through a lot. So to wrap this all up, let's just boil it all down to a final, super simple checklist of the absolute must-remember points. Okay, here it is. Your 3-point memory jogger. Number 1, the golden rule. Never, ever accept more than 2 lakh rupees in cash for a single deal or event. Number 2, for business owners, keep your daily cash payments to any one person under 10,000 rupees. And number 3, know your annual cash withdrawal limit, whether it's 1 crore or 20 lakh, so you don't get a surprise tax deduction. So, when you step back and look at the big picture, these laws create this tight net to track how cash moves through the economy. And there are some very sharp teeth for anyone who doesn't comply. It really just leaves us with one big question to think about. With every single rupee being watched this closely, is the long reign of cash as king in India finally over?